Right. Well, looks like we have almost everyone here, so we can go ahead and kick things off. Just to give a quick introduction, my name is Sarah, and I'm here on the venture team at AngelList. And I'm really excited to be kicking off the Winter 2025 Demo Day webinar. So today we're going to take some time to talk about what AngelList Demo Day funds are and also address some great questions that you all submitted to our fund leads. So before we get started, I wanted to go over a few housekeeping items. First, we'll be recording this event and we will plan it out to send it out to everyone later this week. We'll also post this recording to the AngelList YouTube channel. Second, we'll likely wrap up the webinar around 30 after just to give everyone back some time. And lastly, we'll spend some time going through some Q&A with the Winter 2025 Demo Day Fund leads. We had a lot of questions submitted in advance, but please feel free to drop any additional questions in the Q&A function on your Zoom bar. We might not be able to get to all of them, but we'll do our best. All right, let's get started. Awesome. So thank you all for joining and showing interest in learning more about our funds for the YC Winter 2025 Demo Day batch. For those of you who are not familiar, Y Combinator is one of the world's largest startup accelerators. YC has transitioned to a new schedule of 4 batches per year, which allows for more frequent opportunities for founders to participate in YC and present their companies at demo days. Several big companies have participated in and graduated from past YC demo days. This includes Stripe, Airbnb, and DoorDash, just to name a few. So with that context, where does AngelList come in? Well, now 4 times a year, in parallel with YC Demo Days, we have the distinct honor of supporting 4 esteemed YC alumni who are each launching a fund that gives you the opportunity to invest in the Winter 2025 batch of YC companies. Now, you may choose to allocate your commitment equally across all 4 fund leads, or you can choose to invest in specific funds. The fund leads will leverage their YC connections and experience to deploy that capital to the batch's strongest companies. And the purpose of our webinar today is to meet and hear directly from our leads. They're all YC alumni, successful founders, and experienced investors. So Ben, JJ, Rami, and Yaya, thank you so much for taking the time out of your busy schedules. And we're excited to have you here and learn more about your investing philosophies and overall thoughts. So let's go ahead and start with a quick round of introductions to share with the audience a bit about yourselves and your careers. So why don't we have Ben kick us off, and then we'll go alphabetical order by first name.
All right. Well, thank you, Sarah. Hi, I'm Benjamin. Been doing YC Demo Day funds since 2017. This is going to be my 8th fund that I'm doing on the platform. I was an early participant in Y Combinator back from the winter 2011 batch and the company Earbits, and then moved over to working at Pebble, where we built the first smartwatch, and I was the individual behind our $20 million crowdfunding Kickstarter campaigns. Prior to joining the startup world, I worked in high frequency trading for about 6 years and so 2 hedge funds. And then early on in my academic career, I did a fair bit of computer vision and AI research, early 2000s before anyone particularly cared about it. And then I have an engineering degree from Michigan and a master's in finance from London Business School.
Awesome. Thanks, Ben. JJ, do you want to go next?
Sure. I'm JJ. This is my fifth demo day fund, as I'm super excited about, but I've been investing for 6+ years now. I started a company from winter 2015 called Way Up. We're the largest marketplace to help students and recent grads find jobs in companies' higher early career. I ran that for 7 or 8 years, exited in 2021. When I left the company, we're a little under 200 employees. And where I left, I was invited to YC to come back and be a visiting partner. So I was there for some time, worked with over 100 companies, got to see the inside, kind of how the sausage is made, and helped them raise over $200 million in funding. So at least for me personally, super well placed to know not only how to invest in YC companies, but even understanding like ones that might look kind of weird from the outside, how they got picked. I think definitely it was a really different experience being there and then investing on the other side versus when I just had only gone through the program myself as a founder. So like I said, I've been investing 6+ years now. I had early checks into pretty big companies like Ramp, DBT, Retool, High Touch, and Freewell before I started doing these demo day funds. And then background, before I started a company, I was in a specialized program at Penn for international studies and business. Then backpacked for a bit, like all good backpackers. I went to McKinsey. I guess they recruit out of hostels. Then I taught myself to code, became a fully fledged software developer and DevOps engineer, and then I started the company.
Awesome. Thanks, JJ. And Yaya, would you like to go next?
Sure. My name is Yaya. Most recently, I founded a company called Truebill. Now it's known as Rocket Money. We were in the winter 16 batch of YC. We grew that company to hundreds of millions of dollars in revenue, and in 2021 had an acquisition where we sold the company for 1.3 billion. I'm still there helping out. Prior to that, I've basically worked in startups since freshman year of college. So I did a company with my brothers called webs.com. That was an early build it yourself website tool that was acquired by Vistaprint in 2011. And then after that, I helped build an ad tech company that grew to be the largest ad buying platform on Facebook. So, I have a real soft spot for either consumer apps, web apps, or mobile apps. And I just love working with founders and getting involved in the nitty gritty of actually like driving growth and figuring out like an acquisition model and like scaling businesses.
And Rami?
Hi, my name is Rami Assad. I started and sold 3 companies across which I raised about $80 million, returned about $250 million. One of those companies I took through YC, where not only did I realized the power of the YC program, but built those lifelong relationships with the managing directors, managing partners. I've been investing for angel investing for over 10 years. But last year was the first year I joined the AngelList program here.
Awesome. Well, thank you to all the fun leads for introducing yourselves. Let's dive into some of the pre-submitted questions. And also don't forget to use the Q&A button to submit any additional questions you may have during the webinar. All right, so to our first question, we're now officially in the 4-batch world for YC Demo Day cohorts. Could you please walk us through your investing philosophy and highlight if you believe that the new 4-batch model will change your strategy at all? And Yaya, do you want to kick us off?
Sure. In terms of 4-batch model, I think it's great for YC. I don't know that it necessarily changes the investing model or the strategy. I think when it comes to, there's always a super high selection, like pre-selection already for YC companies. I just remember the last batch just being blown away with the quality of founders. And I definitely think it's come up since I went through the program 9 years ago. That said, I primarily look to check boxes across 3 criteria. Number 1 is just what's the TAM, what's the total addressable market? And I really try to zero in on companies that have enormous TAMs. Number 2 is trying to get a sense for demand in the market. That really comes down to a few things. One is early traction is always helpful, but even in the absence of that, like how obvious is the value proposition? So if this is B2B, how easy a sell is this going to be, and how strong a case can they make for why business should be using them? Or if it's B2C, what does the LTV CAC equation look like? And where do they think they can get that to, and will that sustain huge scale? And then number 3 is just really getting to know the founders and looking at both their track record as well as their way of thinking and their way of problem solving. And if those 3 kind of click in harmony, then I think there's a pretty strong case there, generally speaking.
So, Rami, would you like to go next?
Yeah, I tend to agree with Yaya. The math changes, but the percentages don't, right? So my investment philosophy is to invest in the top quartile of YC companies. I know I'm not going to reach all of them, so I try to do about 10 to 15% of the batch. What we saw in the last batch when they first went from 2 to 4 is that the number of companies in the batch got smaller, so the number of checks that I would write would go down. So that's one of the key criteria of my kind of investing philosophy. The only other thing that I would mention that I think applies to all of us, but I think is really important to say is that I believe that I want to front run Demo Day. In the last batch, 90% of my capital was deployed before Demo Day, and at the point of Demo Day, 50% of the companies I had invested in, more than 50% of the companies I had invested in, had either stopped taking checks or had raised their cap on their valuation, right? And so if you wait till demo day, which not everybody even has access to, a lot of the great companies I think are gone. And so one of the things that's really unique about us four is our relationship with YC to get out a month or more ahead of demo day to front run some of the bigger checks.
Awesome. And JJ, Ben?
Yeah, largely agree. I think there are a couple things, small or big, we'll see, that I think have changed. First is batch size did get smaller. This one is a bit bigger. It's not as big as like summer was last year, but it is bigger. We might end up in a world where each batch going forward of the four is the same size as the original ones were. Does that change our calculus in terms of how much to invest in, or how many checks to write, or what check size? We'll see. Right now, my plan is still to do the same thing I've typically done, which is invest in the top 10 to 15% as I see them. And as Rami said, go really, really early to make sure you can get into good companies. I think the one thing that I've seen that has made a big difference for me in my investing, the batches are actually also slightly shorter, just even by just a couple weeks. I think this has made a difference in how like fully baked the companies are. You're never waiting till demo day, as Rami did say, but it used to be that even if you were getting in early, you could see a bit more traction. So today we just have to, it actually makes it even more important that you have fund leads who really understand how early stage founders operate and how YC picks, because you kind of need to go in and evaluate, are these really good founders who just don't have anything yet, or not anything tangible, which is what at least for me, I've done for all my demo day investments, but it becomes even more important now.
Awesome.
Yeah, I
And
agree. I was going to say, I agree the shorter timeline has made an interesting shift in there. I like it particularly because you do actually get to see the companies a little more in their raw form than you traditionally have in prior years. And to JJ's credit, like being able to read also how YC companies pitch themselves is very important. I mean, if you've been there, you've done it yourself, you know kind of how you can shift and augment the numbers in such a way to give you a prettier picture than is actually there. But largely across the board, aside from shifting to four batches, things have been becoming slightly smaller, which gives you more time to dive into each individual company. Um, I'd also say I've seen companies are moving faster now in the particular landscape. They're getting more revenue quicker. And that really is, I think, very encouraging for stuff because, the speed with which a company can execute is going to just continue to, propagate their success forward. On our side, our investing strategy hasn't changed. I'm a very big believer in portfolio theory, and we curate large, diversified portfolios of YC companies. So we average around about 50 companies a batch. It's gone up to as high as 80. We did about 50% of the batch last fall, and our goal here is really kind of spread money around to get exposure to kind of different axes of risk. If you have a quantitative model that you're looking at for actually how early stage venture works, they're all power law distributed in the returns. And so that means you're really trying to maximize the likelihood that you're bringing winners into their portfolios because they drive a disproportionate amount of return for your company. So, we really take that to heart. We go broad, and then we look to say, all right, there are a couple hot companies that are moving very quickly. We prioritize that, 3 weeks before demo day, get in, get our money deployed, and then continue on through the main I want to say cycle of pre-demo day investing. But at the same time, we also reserve a little bit of capital for the companies that are kind of coming up later. What happens as you go through here is you're discovering more about the companies. And, every now and then you're going to get a recommendation from someone or something's going to, suddenly come on the market that's going to be special. And so, I end up doing this for 7 years. And, the companies that are hot that Silicon Valley blesses, you want to be in those companies. They can come on the market for as little as 24 hours. At the same time, I've had a company I've invested in a month out of demo day. Was not hot during the program. Turns out to be my third highest revenue company from that particular batch. So it's a very broad spread. Like if you think of what you're doing with a startup, you are searching for a scalable business model. Most of the time, you hope that happens before you go through or during Y Combinator, but around about 50% of the companies that go through YC pivot at some point in time in their life. And so it really is, I want to say, a game that plays well to stochastic stuff. You want strong founders, always we prioritize that, someone that's got something exceptional. All the companies are searching for large TAMs. If you find a company that's not really going after large TAM, you kind of realize they're not really thinking about venture the right way, but it's a relatively small percentage of the companies. So, my view is there really is no bad YC companies. And we want to make sure we get exposure to some of the long shots, that people are taking the really big swings, because those will return very well, but they may fail a good percentage of time, as well as kind of everywhere in between. Make sure we get exposures to different trends and stuff, the different geographic markets, whatever may be the mix up in a mix in a particular batch. So that is our angle.
Well, thank you all for diving into your investment philosophies. So we can go ahead and move on to our next question. And some of you already touched on this briefly, but what is your due diligence criteria for founders and their companies? What are the types of characteristics you think are common in successful founders? And JJ, do you want to kick us off?
Sure. I think most of us here are going to say some variation of the same thing, which is you're looking for the top founders, like who is good, who is the best, who is hungry. I mean, the things I particularly look for: formidable, hungry, gritty, meaning they'll stick with it, especially through the hard times, and high trajectory. That often means they know a lot today, but doesn't always. As Ben said, many companies pivot, and it is, in my opinion, much, much more important that you have someone who is very hungry and good at learning. There's a phrase we often say, like slope, not intercept. You want to just see that they'll be able to go like this, not just as a company, but also as people. I am category agnostic. So even, I invest in everything from dev tools, which I know very well, to biotech, which I've come to know very well over the years. And for all of that, really what you need in founders is, PG had a really good essay over the past couple of years where he talked about being persistent but not obstinate. And I will note, even some of the best founders I've invested in, both from how it looked on the outside standpoint, would have been in the bottom decile if you stack rank them by demo day. And one from my first fund, my first demo day fund, just raised their Series A at a 10x markup, and on demo day they had nothing. So it really just comes down to, will you be picking founders who will eventually figure it out?
Great. Yeah, you want to go next?
Yeah, I think what JJ said is spot on. I guess two small things I'd add is, one is I love founders who have really deep domain knowledge in the problem they're solving. So anyone who has a track record of studying that thing and then working in the private sector in that thing, and then has felt the pain point, personally for an extended period of time, and then decided to take the plunge and address it. I think that tends to lead to great outcomes. And then the other thing is, I love getting input from other investors. So typically, when possible, if I'm putting in a check, I always try to connect with other people who have either already invested, or just people in my network who I think could be a good fit, and have them also sort of do a call so we can put our minds together and then really like weigh the opportunity.
Awesome. Rami?
Again, I think we look for the same things. The things that I'll add, maybe some context around what JJ said around grit. What's interesting about YC companies is that they actually last longer than your typical venture companies. If you look at the longevity of companies, after 10 years, YC companies, more than 50% of them are alive. Whereas the industry average is below 30%. So I'm looking, that's what's made YC successful. And I'm looking for that, grit to persist, so that they can kind of take their time to find the time, to have the time to figure it out. And the only other thing that I'll add, similar to Yaya in terms of getting other data points, it's really important to me to get information about how they've done through the program, and that's something that I tend to rely on the managing partners for. You get to see those founders a couple of times. Every chart on demo day looks up and to the right, and you need to be able to understand how to cut through what's a little bit fluff, and really get down to who's actually making meaningful progress over the program, regardless of what that progress is. So that comes from from what they're actually looking to measure, how they're showing their thought process around the key indicators that matter to them, and then what the managing partners say about them.
On my end, we all look for, as JJ said, certain characteristics, but again, most of YC founders have that. I think on my end, again, we're going broad, so I see a lot of stuff, but I am always prioritizing, highlighting something around there, whether it's just someone who thinks differently or just has a little spark. And it's not solely that they are kind of in their siloed little spark. It's also incompatible with, what it is they're working on. I'm always looking kind of for the nuance of what they're up to, why they're up to it, what's their background going from there. And, it varies from vertical to vertical, kind of who's, the right fit. Someone who is, got extensive medical experience is going to be a better fit for a company that is going after, a customer base that's predominantly hospitals or so forth. Like they're going to be able to articulate why they are going to be able to get distribution in that particular domain, or someone that really has deep academic experience in some, small area of AI that is solving a problem that actually at the infrastructure layer is really important right now. And it's going to be complex and it's going to be difficult to understand, but they're the individual that spent the 5-6 years prior working on it, and then you're laying that up against that if we can productize this and bring this to market, now we are opening up an entirely new, larger market, or enabling a much bigger market that they're going to get swept along. So it's everything taken as a whole that really, I think, ultimately drives the decision-making criteria. But, at the same time, I also kind of want to highlight is your biggest risk here is missing out on a top company. My 2017 fund is an upper decile performance according to PitchBook benchmarks. But the reality is I missed on flock safety and, didn't even come on my radar. Had I been in that company, that fund would be 3x bigger in terms of returns right now. And so you can't kind of, I really feel it's wrong to, think about this as something that you've overly analyzed. Like, every investor that invests a certain amount into YC companies does very well. We're seeking to optimize that. We're seeking to use all of the amount of information experience that we have, collective founders, participants in this YC experience kind of can bring to our decision-making stuff. And I think that gives us a little bit of edge that, other investors coming outside can't have. But, it really is about getting exposure. And you will find each and every single one of us, we will bless certain companies, and that's very good. But we're also going to invest in, distinctly different things. And, collectively, we, historically have done quite well, irrespective of our mutually different opinions. And so I think it really is, a testament both to YC and the Demo Day programs.
Great. Thanks all. Now let's shift over to some questions about the startup ecosystem and trends. So it seems like in recent batches, a large portion of companies are either explicitly AI focused or at least positioning themselves as AI powered or AI adjacent. How do you separate the signal from the noise here? And what makes for the most interesting founders and companies in the space? Rami, do you want to kick us off?
Sure, I'll mention a couple of them. Obviously, we recognize that AI is going to be transformative for both technology and standard industries. So it would actually be a little bit of a red flag if there wasn't some incorporation of AI into a lot of the latest companies. A couple of the things that I look at to kind of sift through buzzwords versus viability. One is maybe Sam Altman's litmus test, right? If you look at the major large language models, if they get 10x better, which they will that make your product better? Or will that dilute your product, or will it potentially incorporate what you do into the large language models? That's a great litmus test, I think, for whether or not you have viability in AI. The other thing that I look at is any kind of distribution moats. Have you figured out any kind of go-to-market that will allow you to scale quickly? That is going to be really important feat here, because as we see, building software has gotten cheaper. And so the distance between you and your competitors, the competitive edge that you might have, is going to shrink. And the biggest advantage that you're going to have is how quickly you can move to acquire customers.
Ben, do you want to jump in there?
Um, yeah. So, I mean, yeah, there's a couple things. The fact that everything is shifting to AI, which I really term AI simply as a tool. It has opened up massive markets. I mean, I am a software developer. I work, very intimately with AI, and it is a massive lever for my ability to get things done. And so I implicitly understand it. It's a tool that's really well suited for software development. But then you have so many other different verticals across the globe that just, again, I also went to business school. Business school people do not understand how to apply technology in the way that a YC founder does. The founders have the vision, they have the intimate understanding, the ability to unlock the value that these tools present us with. And so, it being a tool, you still have to be looking at the business itself. It can be a B2B business, but it's going to be a to B business that is using AI to gain some sort of advantage around it. The B2B part still needs to be fundamentally sound. It still needs head to market. So, again, I pay a lot of attention there. We are, as Rami noted, just seeing companies moving vastly faster. I mean, if you look at it, your primary cost might be engineering expenses now. That is coming down so close. And I mean, we see it showing itself in the revenue growth and the speed with which YC companies are moving simply in 3 years. I mean, we have companies that are 5, 6 months old that are now in the multi-million-dollar ARR categories. That would have never happened back in 10 years ago when we were going through the program. And I think it's very, transformative. So that also means you got to pay more attention to your sales and marketing. Like, this is very much a land grab game in the system. And then, there also are other sets of companies, which I would term infrastructure companies. So they're building things that support the AI infrastructure. They are, a situation where if they're doing something right, the whole ecosystem is going to help them rise up. And then you have the foundational models, which, we're not looking at companies that are directly competing against the large open AIs, the Anthropics, the other systems out there. We're looking at the companies that are defining a niche that's very different from that, be it like brainwave data or, we've invested in something in the company last summer batch that was focused on weather prediction and forecasting, risk modeling, other things like that. Like, these tools, while they apply to language models, they also apply to a lot of other domains. And so, what has happened with OpenAI and the whole AI system is it's unlocked the ability to see how can we make this work at scale in other kind of foundational verticals and so forth. So, I don't think in YC there is a lot of noise that you need to pay attention to. The partners are very good at picking companies that they know are the right place and right time for the particular things. They may or may not figure it out completely during the batch, but they are kind of on the right track for that. And so, I think that's part of the blessing with YC companies, is that you kind of are already getting a pre-filter on that. And then inside that, you kind of get to choose the things that make the most kind of strategic advantage for the here and now.
Yaya or JJ?
I think what Rami said about Sam Altman's litmus test is spot on. And I think where that leads is really focusing on companies that are specialized in an area where they're, one, potentially able to disrupt like an old legacy business, but two, really able to develop a unique data moat that will insulate them from the large LLMs, or just tackle problems that that an OpenAI is not likely to go after. Some investments I did that I think really fit that are I invested in a company that is using AI to map the shape of veins in copper mines. Right, that's just not something that a large LLM is going to do, but like the upside there is enormous. Or similarly, there's another company that's doing using AI to assist in the design of large data centers. Again, that's a massive space with huge upside, but they're insulated both in the fact that the big LLMs are probably not going to go there, and two, as they work out this problem, they're going to develop a data moat that's just hugely valuable over time.
For me, I definitely agree with Ben. AI is a tool. I don't tend to think about it from like hype or how companies are like saying they're going to use AI. And there are a few key principles I've sort of formed over watching the past couple years. Especially, it happened to be just by coincidence at YC when AI just started, when ChatGPT came out. So from then till now, the things I've observed, one is it has opened up many industries that traditionally were terrible for startups. They used to be things that effectively would have to be services businesses, and then you can build a great business out of that, but it's not appropriate for a venture-backed VC, tech startup. All of a sudden, with AI, both in terms of automated reasoning, automated analysis, and even voice now, those things become excellent startups, and YC is actually, in particular, soliciting a lot of, and like their recent RFS, soliciting a lot of those. So there are entire industries that have completely changed my opinion about, and I look at those when looking at, you also can invest in founders who have like crazy ideas, not crazy ambitious as, oh, there's tech risk, but back in the day, you would have said these are crazy and like literally impossible. And much more of them now, you can say, this is not possible to do today, but 3 years from now, we now have line on sight on how it will. And again, you're investing in slope, not only slope of the founder, but slope of technology. And sometimes you're making bets on a company not actually being able to make any revenue today, but to be perfectly placed for in 2 to 3 years, when one little thing changes, all of a sudden they'll go straight up. And even though this wasn't a YC company, Cursor's a pretty good example of this. The AI assistant for coding, where for a long time, kind of languished. Then when Claude Sonnet 3.5 came out, all of a sudden it was perfectly placed to use that model to make coding much, much better. Like Ben said, companies are moving much faster due to AI. I mean, even from my past couple funds, I've seen I think 5 to 6 companies each that have hit over a million ARR, and one is close to 10, and that's in 6 to 12 months. Like it's pretty much unheard of from prior batches. And then when I'm talking to companies, one thing that I just use as a rule of thumb to sort of separate like what is wheat from chaff, I assume two things. One is if it is possible to collect data and then perform any sort of analysis or reasoning on it as a human, it will eventually be done by a machine. So what does that mean? Like, what does that mean for your company? If that's is that bad? Is it good? That's pretty important for founders to at least have thought about. And then the other thing, and I might just, this is the way I think about it, and not every investor agrees here. I also tend to assume that OpenAI, just as a boogeyman, is going to eventually want to do everything. They've seen a lot of appetite to do more and more stuff, especially on the consumer side. So this is again when I talk to founders, let's just assume they're going to try to do this too. What does that mean for you? And it's a pretty good bar to at least see have founders thought about this deeply, whether or not they know the exact right answer.
Wonderful. Thanks for sharing your insights there. We can go ahead and shift over to our next question. So a lot has changed in the macroeconomic environment, even since we hosted the fall webinar. So how does the current macroeconomic environment influence your approach to investing? And do you see any trends with the resurgence of crypto? Maybe we can have Ben start this one.
All right. I mean, we're coming off of 2.5 years of quite dry macro environment for the venture industry, like interest rates being high, a lot of money moved to other asset classes. We're seeing the amount of deal activity, I think, kind of as we've moved through fall into now, like pick up. And I think that's a benefit. And then it's macro, who can say where we're headed going forwards, but I think we're largely coming out of that trough and moving forward. What are going to be the big drivers as interest rates comes down, as the economy it gets juiced or so forth? The result of that, that's going to drive exits, and it's going to drive the valuations up. That could be tomorrow, that could be 6 years from now, but I think because we're coming out of a period, we're in a very good position to kind of reap the benefits of a future interest rate drop outside the environment. Outside of that, I think it's also hard to one should not look at the macro outside of where things are with the AI and ability to execute on this stuff. I mean, we've mentioned it a couple times here, but it is very clear that many of the companies today do not need or will not need to raise. So it becomes, a conditional action that if they can bring the money on and they can make their growth accelerate even faster, it makes sense. But it is no longer kind of a criteria of survival. Like the percentage of companies we're seeing in recent years that are now, if they chose to be cash flow positive, is an order of magnitude bigger than it was, in prior batches there. So I think it really changes, the calculus for early stage investment, as a result that, this is our opportunity to get money into companies that really are able to set their destiny, moving forward. And, I think that's very, very good from, our perspective.
Yeah, you want to jump in there?
Yeah, echoing what Ben said, I think the next 4 years are going to be a really hot time in terms of M&A activity. That's largely been paused for the last 4 years, and I think companies have been saving their powder and they're ready to kind of been waiting for the market to get to a right place to start deploying that or to heavily deploy it. And I think we're going to see that either certainly during the Trump administration at some point. Also echoing Ben, with regards to the amount of capital needed, I think over the last few years, what we've seen is companies start raising larger seed rounds, with lower burn rates following those rounds. And so for the last batch of companies I did, most of these companies in their updates are saying they have 36 or 48 or 60 months of runway. I just think that wasn't the case 5 years ago. And so it does change sort of the trajectory of how these companies are going to raise funding and the milestones they're going to hit before needing more capital, which also makes the seed stage kind of, I think probably the most exciting it's been in the last several years.
Yeah, I agree with both of those. What's funny is, a couple batches ago we talked a lot about interest rates, and as much as may go up, may go down. I think just with AI, and it's not only AI native companies, it's just AI even enabling completely AI unrelated companies to build better and faster. The seed stage companies and pre-seed companies are moving at such a level that no matter what happens with interest rates or broader macro, this is one of the most exciting times I've ever seen, to be in early stage and especially YC companies. So I have not too much more to add there. I think Yaya and Ben handled it well. The one thing I'll add, because I don't think anybody touched on crypto, is I don't know, a huge resurgence in crypto for me, as much as I'm starting to see for the first time more normalized use cases where it actually can be useful rather than a lot of what might have been hype in the past. So there have been in the past few batches. In this batch alone, actually, there are already a couple companies using stablecoins for either cross-border payments or FX. And you're starting to see fewer companies that are just all crypto and more companies that are like AI integrating into their product as one of a number of mechanisms. That's happening with crypto as well. You're seeing many companies also that are thinking about how do AI agents perform actions in the real world on our behalf in a way that is automated. And a lot of things in the banking system make that difficult. And crypto can make certain transactions uniquely possible. So all that stuff is pretty exciting. I don't know I would consider that a step function change, particularly in the YC batch, but it is an interesting trend.
I one thing I'll add to what Yaya said, I completely agree. We are in the age of efficiency, right? Whether it's DeepSeek or Doge or the layoffs at Meta, you see more people trying to do more companies doing more with less, right? And that was kind of Yaya's point in terms of how long it takes them to need more capital. But this age of efficiency also goes the other way, for customer adoption. More and more, I'm seeing traditional industries really break out of the traditional crossing the chasm mold where the technology adoption life cycle starts with early adopters. It's come into the main light and it's accelerated Main Street's willingness to adopt technology, right? We saw ChatGPT was the fastest tool to 100 million users, and we're seeing more and more traditional industries that are craving AI adoption, and that extends the type of companies that I tend to look at now. It's no longer just startups selling to other startups. It's startups selling to chemical plants and and more traditional Main Street types of companies. HVAC, one of my HVAC companies is actually one of the fastest growing ones we have, right? In one of my last year batches. So it's really interesting seeing people's willingness to embrace AI.
Amazing. Well, we have a couple of live questions that have come in the interest of time, we'll do a quick lightning round. So, leads for the next two questions, let's try some rapid fire answers, maybe a sentence or two. So, for our first question, in 2025 and beyond, what are one or two major roadblocks to startup scaling? Maybe we could have Yaya go first.
Yeah. Like, I think the barrier of entry to starting a startup is lower than it's ever been. And so the amount of competition for startups is shooting up. What that means is two things. One is that if you have a good idea, it's pretty likely that you're going to have a number of competitors that you're struggling to differentiate yourself from. And then on the other hand, as a consumer, I think, there's a risk of consumers just being overwhelmed with all the new products and possibilities hitting the market. And as a consumer, you can only adopt so many new technologies or so many new products over a short period of time. And so competing for that attention is going to be difficult.
Yeah, Rami, would you like to jump in there?
I think more than ever, the power law is kicking in. The companies are growing so much faster, and so there's a higher bar, a higher expectation, right? If you go and 10 years ago, you get to $1 million of ARR, you can probably raise a Series A if you do that in 12 to 18 months. Nowadays, that's not the bar anymore. So the expectations have grown, and so that you have to be smart with your capital, and you have to be able to lean in and grow quickly when you find that product market fit. And knowing how to pivot on that point is really critical to the success of these companies.
Maybe we could do JJ and then Ben.
Sure. A lot of reasons. I agree with all those. I have two specific ones that I focus on. So one is, funnily enough, as much as AI lets you be able to be lean, companies still need engineers as they grow, and they often need not just engineers, but actually a smaller number of much better engineers. Engineering hiring is harder than ever somehow, despite everyone needing fewer. So I look at that. That's one of the reasons. Just from my company, I'm a specialist in hiring engineers. That's something I help companies with. The other one, kind of similar vibes, is as companies are growing so much faster. When I had my company, I had the time to learn how to manage infrastructure and scale. When companies go from 0 to 10 million in 7 months, you just don't. And they don't have the time to develop that expertise on how to make sure everything is not on fire. So that's another thing that I help companies with.
I guess would say that as it becomes easier to build, it really is, an importance of how do you sell yourself and market your stuff, which traditionally for most early stage companies has been an area that's not respected. But what we're seeing, have seen is like you're really seeing, NYC, the founders that actually have both. And I think that's always, kind of been a bit of the tenet of YC. It's not just about building something, it's about building something that people want. And then YC kind of provides the structured engine to say, like, this is a playbook that we can, run to really kind of have advantage that others aren't out there. So, if you can build it, it's about finding the customers, but that seems to be going well. So.
Great. And for our second lightning round question, how do you get to know and pitch founders when the timeline is so compressed with YC? And maybe for this last question, we can go in alphabetical order. So Ben, JJ, Rami, and then Yaya.
Yeah, I mean, so, I'll do a lot of our work ahead of time. We have the ability to research and dive into companies. We know people within the ecosystem. So we, do all of our homework up front. And then, we take a half an hour call with the founders, and that's where we make our decisions off of. I mean, that is how the game plays. Again, your priorities are not missing out on around here. So moving quickly is very important. And, as we've gone over the years, like it really has, you've learned the one thing you optimize as a demo day fund lead is being able to get the conversations and get allocation in the companies. So, everything we do outside of operating the fund is drive towards, that one goal, have a great brand and reputation.
Well, thank you all for answering those lightning round questions. And it looks like we covered almost all the questions that we could get to today. So again, thank you, Ben, JJ, Rami, and Yaya for sharing your backgrounds and insights into your investing approach. You can find additional information about each of these offerings on the fund pages and on our Demo Day website, which we'll drop in the chat. And a huge thank you to everyone who was able to tune in today. We really appreciate you taking the time out of your busy schedule. And as a reminder, we'll send a follow-up email with the recording of today's discussion. And if you have any specific questions that we couldn't address today, please feel free to reach out to demoday@angelist.com, and our team will provide tailored insights. And have a great rest of your day, everyone. Thank you.